All right. Welcome to Forex Fridays. I hope you had a great trading week. Or if you didn't, I hope that the losses or no trading that you took was sustainable to your account and equity. I want to say that this month was very interesting to trade, especially the last week. Besides like the yen crosses and those swing trades that we were talking about with AJ and all the other yen crosses, those were nice, but this last week was very interesting. The markets were doing things so funny, but the stock market, with the bond yields, with the DXY, everything was very interesting with the last week of February. So we're out of February. We're going into March. We're going to be going over our weekly range review, our pair filtering process, how we break down how we're going to select a new pair going into each month. We're going to talk about EU and its March speculations. So that poll that we had in the Telegram channel, we had EU, AU, and gold. And gold and EU were neck and neck. And eventually by Thursday night, I closed the poll and EU had won. So we're going to be going with EU for March. And we're going to talk about what I am looking forward for that month. We're also going to talk about bond yields versus DXY or correlations around bond yields and interest rates. And then we're going to end it off with probably some gold speculations and either some speculations of other asset classes that I'm looking at. So let's jump right into it. So, weekly range review is our first topic. As always, it's a very simple approach. What we're looking for is simple models that we see on a day-to-day basis intraday and how they frame around the weekly opening price. So those that are unfamiliar with the weekly opening price, and this is their first time seeing this, the weekly opening price is fair value. You're not paying a discount and you're not paying a premium. But as soon as price gets above that weekly opening price or fair value, you're going to be paying a premium. And you're going to look for most likely ideal sell conditions and vice versa. When price is below that, you're going to be in a discount. You're looking for ideal buy conditions. I want to check before I continue. Can you guys hear me? Can anybody in chat just shout me and say, yo, D, I can hear you? Because I always do this all the time. I want to make sure you guys can actually hear me. Cool. All right. So the weekly opening price is going to normally put you on the side of whether you should be a buyer or a seller. That doesn't mean outright just because price moves into a premium range or premium territory doesn't mean you have to just click sell on your, MT4, whatever platform you're using, and vice versa. Just because it drops in a discount doesn't mean you have to immediately click buy. You need time and price to line up, and it needs to be in a certain area, right? And there needs to be something happening. Is there liquidation occurring? Is there a fail of a break? Or is there a false break occurring, which is the liquidation? Looking at this chart overall, just looking at its general premise, right? No indicators, just raw price action. Looking at this chart. When we take this line off, it looks like a whole bunch of nothing, right? Especially when we have the day dividers. I divided it on the hour, right? On the 1 hour chart. It looks clean on the 1 hour. But when you put this line back on the chart again, 5 p.m. It's going to be 5 p.m. Depending on the asset class that you're looking at, it's going to be 5 p.m. If it's gold, I believe gold is 6 p.m., not midnight, not midnight Monday. So the markets is open on Sunday. You can see here, this is Sunday. If you look at the bottom of the chart here, just answering a question in the chat, you can see here, that's Sunday right there. And if I move my cruiser to the left one tick, you can see that's Friday. If I move it over, going into Sunday. So the market's open right there. That weekly, and if you don't have the weekly opening price on the platform that you're using, most people should. If they're using TradingView, you have access to this. But if you don't use TradingView and your platform that you use does not have has Sunday's data, just use Monday's opening price midnight. That's a way to work around that as well. But just looking at this price, when we take this off, it looks like a whole bunch of nothing almost. I know some people may speculate and read it, or might be critical thinkers, but to the average person, when they look at this, it just looks like price is going up and then price is going down and then back up. But when we put this line on our chart and we add a little more context to it, then things get a little bit more clear. We see that there is a line in the sand where the premium territory lies and the discount territory lies. The best buys we can see for the week with hindsight, of course, is happening below the weekly open. It's a given fact. And vice versa, the best sells, greetings. Welcome, guys. Welcome, welcome, welcome. The best sells are occurring in a premium. You can see on Wednesday, the best selling opportunity was happening above the weekly open for it to get right back down here Thursday. And then the best buy opportunity happened down here below weekly open, back up. Friday as well. Runs all the way up here and declines right back down to the weekly open. So it's very interesting to see its natural flow around the weekly opening candle. As we know, power three, open, high, low, and close. Accumulation, manipulation, distribution. It's happening on the weekly time frame, meaning the weekly candle, the weekly bar. It's happening there. There's going to be an accumulation phase, a manipulation phase, and a distribution. Now, it's not going to always be picture perfect. It's going to come at you in different ways. And some are very hard to digest or hard to analyze. But overall, we know that if the market's going to move higher, let's say we're speculating going into the last week of March for DXY, we're speculating a higher weekly candle, right? Per se. We know that the high of the week is normally going to land on either a Thursday or potentially a Friday. And then the low of the week is going to either land on a Monday, Tuesday, or Wednesday. So we get price going up, bringing retail traders to the wrong side, getting ready to run back up into a premium territory and either continue that trend higher into Thursday, Friday. And we can see it sells off, consolidates into Thursday, Friday runs up one more time, and then we get a sell-off. But that's generally what we like to see. Vice versa, of course, when bearish, you would like to see the high of the week come in on Monday, Tuesday, or Wednesday, and then Thursday, Friday be the low of the week. That's your picture perfect scenario in its most simplest form. Going into Monday and Tuesday, we're going to be talking about the New York model, right? The very simple approach that I like to use when trading intraday. Yes, there are many other models. Yes, there's many other techniques out there, many different formulas to how to find a trade setup. I just find this to be the most simplest way to find a setup intraday. This is my personal take. Now, you may have a different opinion, but I'm just sharing you what I like to do to be successful. So let's bring it back to Monday. So the New York model is going to be using a dead zone and a live zone. So the live zone or the live session or the kill zone is going to be the New York kill zone, which is from 7 a.m. to 10 a.m. The dead zone that we're going to be utilizing is going to be from 5 a.m. to 7 a.m. Let's bring it right there. So right in between here, 5 a.m. and all the times that I'm talking about is in New York Eastern Standard Time. I live in New York, so I don't have to calibrate my phone or my watch or whatever to New York time. But if you live anywhere else on the globe globally, I know TradingView would allow you to switch over to New York time. So you'll have your charts acclimated to New York time. This is the dead zone. I don't like to trade in this time period because most likely the market is going to be in a consolidation or a deep retracement. Those are two unwarranted conditions that I don't want. What we're looking for, though, on a 15-minute time frame is liquidity pools that are residing here to help us trade 7 a.m. to 10 a.m. That's all we're looking for every time. Hence, do keep in mind we have the weekly opening price here. So we're below it. Keep that in mind. We're below the weekly opening price. This line here, weekly opening price. And when we're below it, we're in a discount. Ideal buying conditions. We're going to find all our liquidity pools inside that little time period here. And let's just write it out so we're being transparent. It's 5 a.m. to 7 a.m. And this is the London lunch because it happens after the London kill zone. So it's the London lunch. Do not trade here. Unless you're already holding a trade from London session, then let it ride out. But if you don't have any trades, wait to New York session to start trading. Once you start trading in this time period, you can run into consolidation or deep retracements. Unfavorable conditions. And this is going to be 7 a.m. to 10 a.m. And we all know that's the New York kill zone. When I say kill zone, I'm referring to the ICT kill zones because I know the session, we know that the true New York session does extend way further than 10 a.m. I'm referring to the ICT kill zones here. We have that high here. It's not a swing high, but it's a high. It's the highest point at 5 a.m. between this period for the New York, for the London lunch. So we're going to take this as a buy side liquidity pool. We also have this swing high. So we're going to take that. So we're primarily looking for either the highest high of the session, the lowest low of the session, or swing highs or swing lows that are unbroken. And right here, going into 7 a.m., you can see right here at 7 a.m., it comes down and takes out that swing low. So that was sell side liquidity. So you have this liquidity pool here, we have this liquidity pool here, and this one here. And we can see it was tagged right at 7 a.m. or that 7:15 candle. Hence, we're on the 15-minute time frame. 7:15 candle. We're going to mark off the opening price, which is the same ideology that we just discussed about with the weekly opening price. The same thing is found here. Anything above it is going to be in a premium. It's always going to be the same. Nothing changes. It's all fractal ideas. This is a premium territory for the session. Vice versa, down here is going to be a discount. So you know where we're likely to find ideal buys and ideal sells. Doesn't mean we just click buy and sell because it's in a certain territory or a certain environment. We need context behind it. And I'm trying to provide the context in the steps I'm providing here. So step one to the New York model, find your liquidity pools between 5 a.m. and 7 a.m. on the 15-minute time frame. That's step one. Step two, mark off the 7 a.m. opening price. So we have an understanding where we're overbought and oversold. We don't want to be selling in a discount. It's just unideal. It's not the most realistic condition for a retail trader, at least. Vice versa. We don't want to be looking to buy in a premium because we're buying much more expensive. We want to buy cheap, buy low, sell high. That's always been the game, no matter what you trade. That is a purge on sell side liquidity here. So what do we have left at this point? We have buy side liquidity left. We also have this last 15-minute swing high here that I didn't mark off because I know people are going to be like, you forgot this one. It's okay. You don't have to mark off every single one, but for transparency's sake. So raid, right? Purge right there on sell side. What do we have left after purging the sell side? We have buy side available to us, and we're already cheap. We're below the weekly opening candle. The opening price right now, the candle, if you were looking at this on the weekly time frame, the candle at this point would be colored black, right? It would be down because it's below the open. It would be a black candle at this point in time. So it's cheap. Now, this could be the Judas swing for the weekly candle. It's either going to form on Monday, Tuesday, or Wednesday, the fake move on retail traders. If that weekly range expansion is going to be higher, it's going to be a fake move on Monday, Tuesday, or Wednesday. Those 3 days are where you're going to find the Judas swing. We go down to the 1-minute time frame. Now, since we are looking at the DXY, it's going to look a little more funkier than our major currency pairs. You're going to see a lot more volume imbalances, a lot more gaps, a lot more interesting price action. And we play it forward. So right there, we got that purge on that sell side liquidity. And we're looking for a simple idea. We're looking for a fair value gap that is broken. Sorry, a fair value gap that runs a swing high. We don't have anything here right now. Let's play it forward. So play it forward. Look at how close price gets to the open. It looks like it was gonna continue trending higher, but look how close it gets to 7 a.m.'s opening price, and then it just turns completely around. So that's why you got to be patient. Wait for the entry idea. Keep playing it forward. Nothing yet. Speed it up. Price runs up, and right here. Let's bring it back right here. There goes our entry idea. So we got that sell side that was ran on the 15-minute time frame on the 1 minute. Now think about it. Many people do struggle trading on the 1 minute, but I'm going from the 15-minute time frame down to the 1 minute time frame. It's not that I started on the 1 minute time frame, because if I started on the 1 minute time frame, I probably would have less context on where the market's likely to go and draw to. I'm using the 15-minute time frame liquidity pools to gauge where I want price going in the next couple of hours during this kill zone. Here we have a fair value gap that runs a swing high formation. That's my entry technique. I love this entry technique. I see it very often, very frequently, and I tend to see a lot of success with it. Am I sitting here telling you it's guaranteed 100% that if you find an entry technique like this, you're always going to get a banger? No, that's not true. Nothing is guaranteed. That's the game we play. That's what we signed up for. We play it forward, wait for price to hit that, and that's where we would look to go long. Right? How would we go long? And I know most people don't trade the DXY in general, but if we had to look at it from this point of view, 15 pips for 15 pips, or 15 ticks for 15 ticks. And we'll play it forward. Now, of course, we will find drawdown from time to time. Not all of our entries will be perfect. Dime stop on our entry and continue trending higher. Sometimes we adhere some drawdown, but that's where risk management comes into play. We risk properly, so we're able to adhere this drawdown. We're not in fear of losing. Even if we take a loss in a trade, we had what? We had that responsibility of taking great risk management. So we don't have any fear of losing. Okay, it's just 1% loss. Okay, we took the loss. It's only 2% loss. Okay, we took the loss. It's only 3% loss. Anything beyond 3% loss intraday, it's a bit much. Being 3% down is probably the max amount I would ever want to be down in any account. 4% and on, ooh, now you're kind of digging into a rabbit hole here. You're down 4% on your account. It's gonna get a lot tougher on you psychologically, right? And also now you're going to want to go into bad habits, revenge trade. I can mitigate these losses today. I can do this. I can do that. You don't want that. That's the whole point of having your trading psychology tip top and having your risk management tip top. You don't want to have to go back and be like, dang, I should have done this. I should have risked less, right? A lot of traders say that all the time. I should have risked less. Why? Because you would not have gone into bad habits again and spiraling into risk risking more than you should have, or revenge trading. And we play it forward. And this is London close at this point. I'm going to fast forward it a bit. All right, it's taking a while here. And then we went into the new day. And we got stopped there. And then price runs up and hits our TP. So remember to always pay the trader at said point. Now, let's say you accomplish at least 50% of that trade. Take something off. You accomplish 80% of that trade. Take something off, because you have moments in time like this when price comes down and stops you out. And that hurts to know that you've got it right. You spent the time to wake up, be on time to this kill zone, watch the chart for a couple of hours, get the entry finally, get the entry and get profit. It's the worst feeling to see all that profit go to nothing. You didn't at least take something off the table. So that is our New York session model right there that we just talked about. We have another example on Tuesday. So the same idea, the same premise. We'll walk through it together. The same idea. We have a lot of New York models tonight, so you guys can get a gauge and understanding of the flow of it and the steps. It's a very simple model. You can write these steps on the back of a business card. That's how simple the model is. So we're going to go from, let's figure it out, 5 a.m. to 7 a.m. and then 7 a.m. to 10 a.m. Bring it back here. So this is Tuesday. Not to mention, we're not even talking about midnight opening price here, too. If the true day open, right? 12 a.m. opening price. Think about that as well. So there's an opening price for the actual IPTA true day when the algorithm is ready to gauge itself to start seeking and assuring liquidity and creating liquidity. It's the same concept. Anything above the midnight opening price, 12 a.m. opening price, is premium. Anything below this midnight opening price is a discount. Your best buys is going to be below 12 a.m.'s opening price. Your best sells are going to occur above 12 a.m. opening price. Notice where we are as well, below the weekly opening price still. Sunday's opening candle. We're still below it. and we're going into a Tuesday, an ideal trading day. This is the lowest low between 5 a.m. to 7 a.m. So we're going to take that at that 7:15 candle. We're taking that as our liquidity pool there. We have this swing high, buy side liquidity. What makes that a swing high? Because the swing point, the candle on the left has a lower high and the candle on the right has a lower high. A lot of people still have troubles. I know some people have difficulties identifying swing highs and swing lows. And I just defined it for you. It's a candle that has a lower high on the left and the right. It only takes 3 bars. In this, I think these are equal highs, double tops, but we'll mark it off anyways because it's a liquidity pool that is still going to be influential to price on our draw. We got the 7 a.m.'s opening price here. Same idea. So this is the open. Anything above it, premium. Anything below it, discount. 7 a.m. Play it forward, see what happens. Price comes down, it takes out that 7:15 candles low right there. Purges it. What do we have available to us? We have buy side still for the kill zone. Let's go down to the 1 minute after taking out that 15-minute low. Price takes it out. We're going to be looking for a fair value gap that runs a swing high. So let's play it forward. And this entry technique needs to form below 7 a.m. That's something I missed out on the last example here. Notice this entry technique here is forming where? Below in a discount. I'm not buying up here above in a premium. I'm not doing that. I'm buying in a discount. I want to buy cheap every single time. Every time. It's just the best case scenario. Now, sometimes the best case scenario may not happen, and you may not even get the entry, but at least you're being very meticulous and being very strict to your guidelines in your model. Would this be an entry technique? Yes. Now for the DXY, I'll make the exception. The reason I say that is because we have a volume imbalance here, right? The candles aren't touching. Another PDA array, if those are not familiar with ICT, another PDA array here, a volume imbalance. That means this candle opened, closed here, and the next candle opened and left a gap here, right? So that's inefficiency. Market fills it. So we could see that I would include the whole thing as the fair value gap. I'll include that volume imbalance. So this is where the volume imbalance is. I'll highlight it in a different color so you can see it. And that didn't do it. That's the volume imbalance there. The candle opened with a gap and then continued to trade higher. And then price rebalances it. So I would include it inside this fair value gap. And we can see it runs through what? Swing high. So you see price trades down into it. It's probably going to look to trade higher. The same premise, the same idea. Let's say we're looking to go long right there at the top. Premium side of that inefficiency. Question in the chat. Someone had said, so is it very important to see the DXY first before taking any XX USD or USD XXX pairs? Yes and no. If you're really, how should I put it? If you're really looking for the best confirmations, the best ideal case scenarios, you would want to have it side by side. You'll split screen it, right? Or divide it into 4. You'll look at the DXY and look at some other pair that you're trading at the same time. And when the DXY breaks a low, what does other currency pairs that are directly correlated and inversely correlated doing? And you'll start to gauge and see, okay, I may be onto something here. Or you may say, oh, there's something wrong here. The DXY broke a low, but gold didn't break a high. Do we have an SMT diversion on our hand? And you'll start to speculate and see, okay, maybe this trade idea is less favorable because it's not following market code and something else is unfolding. So yes, you can look at the DXY while looking for intraday setups on other currency pairs as well. It would be helpful. It's another resource or another way to give yourself an edge. You look to go long, you hold that, and notice where we're looking to go long, we went long in a discount. Price goes up and raids out all our liquidity pools that we formed on the 15-minute time frame during our London lunch. That's how simple the idea is. The idea will not unfold every single day on the pair that you're watching, but it will unfold every day amongst all other pairs. So let's say you're looking at dollar, and today dollar gave the New York model, but maybe AU didn't give the New York model at all. So it's the luck of the draw and what you're looking at that day and what's on your watch list. But if you stay consistent to the idea, sooner or later, you will catch the win. And I'm not sitting here telling you which pair you should be seeking to use for these models. In general, the overall premise is you should be focused on the majors when it comes to trading FX. Anything else like the crosses or any exotics, leave it alone. You're wasting your time. Focus on the majors. Until you get enough, skin in the game, then you start venturing off outside of the majors and trying to use other crosses. But if you're someone that's still starting off, you got a couple years underneath your belt, stick to the majors, get those down, get those fundamentals down. And there we go. The New York model was successful. So 15 pips or 15 pips, 15 ticks for 15 ticks here to DXY. And price was adhering to exactly what we would like it to do. Purge sell side, revert back to buy side. A turtle soup condition, right? We got a reversal. So the market's trending down, trending down, trending down, right? For these few hours, it was trending in this direction. But then all of a sudden going into New York session, change in trend. Market completely changes trend there. So for those that like to trade on the 1 minute time frame, it can be very difficult if you don't have context behind what you're looking for. I'm providing you the context. You can see the context on the chart. The liquidity pools, the opening price, the time windows that we're looking for the liquidity pools, and where the entry is occurring below 7 a.m.'s opening price. So that's our New York model for DXY. So let's move on. We're looking at GU. Now, GU had a ton. So I was looking back before we starting, doing my homework. GU had a ton of New York model examples, a ton of them this week. So if you were looking at GU, you definitely found success using this model. So just looking at the chart, in hindsight, you got the weekly opening price, same ideology. Look at where the best buys are coming from and look at where the best sells are occurring. You can see the high of this weekly candle was on a Monday. Right there. Monday was the high of the week. And then down here, Friday was the low of the week. So very opposite ends of price point here. So price from here sold in a premium, and then price down here found buying conditions multiple times. So buy here, there's a buying condition here, there was a buying condition multiple times in this day, buying condition here as well. So let's go down and look at the New York model for each one of these days. So we got a few to go through. I'm not going to rush them. I'm going to take our time because the more you guys see it, the easier it is to understand the model. And then we got one London model this week that I thought was reasonable to talk about. So let's look at Monday's New York model. So the same idea, but now we're looking at a major currency pair. We're not looking at the DXY. So bring it back to 7. I didn't mean to do it like that. And then we'll drop down to the 15-minute time frame. So this is how I would be doing it if the market was live. If the market was live, this is exactly how I would be doing it step by step. I'm showing you exactly how I get to the execution and the trade, whether it's win or lose, just sticking to the model. We got 5 a.m. to 7 a.m. Now I'm going to ask a question just to engage with you guys because I don't want you guys to sitting here listening to me. I'm going to ask the chat. What is this time period? Do you guys remember what we call this time period from 5 a.m. to 7 a.m.? What's the name of this time period? Anybody in the chat can say it. Dead zone. Correct. That's a good term. Yeah. What's the other word? London lunch. Good job. Those are great answers. Thank you, guys. Shout out to the chat. So 5 a.m. to 7 a.m. is our dead zone. We are not looking for trade ideas during this time period unless we've already found a trade idea in London, kill zone, and we're riding it out going into the rest of the day. We don't like to trade in this time period because we're either going to face consolidation or a deep retracement. Those are two conditions I just personally think as an intraday trader you don't want to face. So let's save ourselves the heartache and troubles and not even trade during this time period. If you didn't get a setup in London kill zone, do not force yourself to trade between 5 and 7 a.m. Wait to trade during 7 to 10. It's better for you. It puts statistics on your side a lot more than not. We're looking for the 15-minute liquidity pools that we have available to us via 15-minute time frame. Crucial thing here. I'm always using the 15-minute time frame. Let me have one right up here. So you can see this is a good question. I know people want to ask, why did I not mark off this high instead of this one here? Well, because at 7 a.m., so I have to make the exception. Before 7 a.m.'s candle even opened, or the 7:15 candle even opened, or whatever the case may be, there was a swing high that was still intact before the kill zone opened, and then it ran through it. So I like to use this as our purge. So hopefully that clarifies some questions that some folks may have. So we have a purge on buy side already, right there. Let's get everything up. 5 a.m., 7 a.m., London, lunch. New York session. Keep it short and simple. So we're permitted to trade here, but we're not permitted to trade here. We got the 7 a.m.'s opening candle here. Same idea, premium versus discount. Notice as well, we are above the weekly opening price. Sunday's opening price, we're above it right now. Going into Monday's New York session. Prices purge buy side liquidity. Great. Awesome. Now what are we doing? We're just stalking the setup at this point. We're not going to sit here on the 15-minute time frame. We're going to go down to the 1-minute time frame and stalk the setup. Let's go down to the 1-minute time frame. We're looking for a fair value gap that forms above the 7 a.m.'s opening price that runs through a swing low. So everything vice versa for the sell condition. We're running buy side and we're getting a fair value gap that runs a swing low. So let's play it forward. Right? Notice how price comes down into this fair value gap right here, and also being cheap again. So you can see the market makers or the algorithm is strategically, methodically pricing itself cheap to find a buying opportunity, runs itself right back up. This is why I don't like to chase price. FOMO is a big problem amongst the retail traders, missing out, right? The average trader is just so nervous, so high anxiety driven. They think every single tick or every single move, they have to be in it. You don't have to. Sitting on the sidelines is most likely going to be best for you in a lot of case scenarios. No trade taken is no loss to your equity. That's your safest bet. When you don't trade, you are safe. But as soon as you put a position into the market, you're not safe anymore. You're exposing yourself to losses or risk. So sitting on the sidelines is probably your best option 10 times out of 10. Just keep playing it forward. Play it forward. So we got nothing here. So you can see price does not give us, actually, no, we don't. We got no fair value gap that runs a swing low here. But we can see how price does bring itself above 7 a.m. to get down to this sell side liquidity pool. So it purged buy side, got down to sell side liquidity. At this point, in my mind, in my idea, would I be looking to look for a long position at this point? Not necessarily. Why? Because we're above the weekly opening price. I don't like that. There are going to be times where you will be forced to buy in a premium, but I prefer to stay away from that. I want to always buy below the weekly open, and I want to always sell above the weekly open, unless it's a swing trade idea. That's the only exception I would make. If I'm looking for a swing trade idea, then I will buy at higher prices for price to trend higher. or if it's going lower, I will sell at lower prices. And that's just the way the game would work. So play it forward just to see how it plays out. There we go. So all the same liquidity pools that we had made here from 5 to 7 a.m. This is just to show you're not always going to get the entry that you may be looking for. Now, the entry technique that Deontay is showing you may not be the one that you want to take. You may want to take another idea. You may want to take a Larry Williams smash day entry idea. You may want to use a mitigation block. You may want to use a breaker block. You may want to use an order block. You may want to use a volume imbalance or a gap as your entry idea. But best believe where you're getting that entry should most likely be in the best position possible. It needs to be above 7 a.m. That PD array that you're looking for, you really want it to be in above in a premium. You can see it purges buy side, takes out the liquidity pools that we formed here on the sell side liquidity. So just showing realistic conditions here from my approach. So me, Deontay, ain't no trade being taken here. I couldn't find a trade setup. I move on. Do I get, sulky about it or do I give up on it? No, I do not. I just say, move on, next trade. We have another day. We have something else to look forward to. We have the Asian session to look forward to, right? So if I didn't trade the New York session, okay, let's see. We might have an opportunity during Asian session. If not, let's keep going. Don't give up. A lot of people give up. And as soon as they give up, that's when the model starts to show itself again. As soon as people lose faith in their own model, whatever your model may be, people lose faith in it and they go against their own model. And then their model finally shows. And everything is showing them the signs that their model is playing out each step. But for some reason in the back of their head, they're like, nah, I'm not going to listen to it. I'm not going to listen to it. They don't listen to it. They take the loss, and their model that they actually formulated for themselves actually plays out really well. And then they, beat themselves up and they feel guilty. That's how it goes every single time. Moving on, going into Tuesday. So we're going to talk about our first London. Our first London. Let's get it back here. Model. Someone said something in the chat. As per high probability scout video part 1 and 2, where should we exit? You're most likely going to be looking to exit on the next day's previous daily high or previous daily low. If not, you can use standard deviations, that could come into play as well. You can use the Asian session standard deviation, you can use the central bank dealers range standard deviation, you could be using a weekly, swing high or swing low, or you'd be looking to trade into some type of higher time frame PD array, whether that is, you're taking the entry on the 15-minute time frame, but you're looking for price to run into a 4-hour or 1-hour PD array. So something along the lines of that. And if price is already broken that previous daily high or previous daily low before you got to your trade setup, still look to trade in that direction and find another draw on liquidity. Has to be either a swing high formation or some type of rebalancing of a zone, aiming for clean highs or clean lows. Good question. It's 2 a.m. Here we go. So the London model, same idea. It's just using a different kill zone. It's using a different liquidity pool at a different time. So it's using midnight to 2 a.m. before going into European Open, 2 a.m. European Open. So we mark it off. So here to here, these 2 time periods. This is going to be our Asian lunch. I call it the Asian lunch just because it comes after Asian kill zone. So it's Asian lunch. It's going to be midnight to 2 a.m. Same idea, 15-minute time frame. We're looking to find any buy side liquidity pools via 15-minute time frame or any sell side liquidity pools via 15-minute time frame, primarily around the swing points. That's what we're looking for. The swing points are going to be the obvious areas of liquidity pools. It's very easy to see. We got the London Open. That's 2 a.m. or European Open or Frankfurt Open. And we have this. See this swing high right here that forms at midnight? Look at how that 2 a.m. candle runs right through it. So we're going to be using that as our purge or the gauge to breaking buy side liquidity. So there it is. We also had one just prior to that too, here. It also ran that one too. But then after running that, what do we have below? We have the sell side liquidity that's still residing below these swing lows. Got one here. You got one here. These are clean lows too. So it's very clean on a 15-minute time frame. You know it looks very clean on the 1 minute for sure. So just put $1 sign down here. These are all relatively equal lows. Retail traders are probably trying to draw some type of trend line here, right? Phantom trend line. Let's go down to the 1 minute time frame. See what's going on. So we got some very clean lows. And we like the dead zone because if the dead zone is going to give us consolidation like that, we know we are most likely primed to have a movement, have a market that is more dynamic to move. All markets start in consolidation, and these dead zones generally give us consolidations. That's why I really favor this model, especially when it gives us the consolidation here. You can see it, even though it trended down towards the last couple hours of it, you can see it was consolidating. Buy side taken. This is the first level taken out. So it takes out 2 levels here. So this might be a question that some people ask. What happens if it takes out the first one? Am I just waiting? Yes, you're going to wait. Even if it takes out another level, you still wait. It's until the entry point shows itself after purging any buy side liquidity or any sell side liquidity. That's the whole point. So it could take out this level here and still not give it the first level here and still not give an entry technique. And it could continue trending higher and take out the second one and still not give an entry technique. Let's say there's another level that was higher than it. It finally gets to that third one and then it gives an entry technique and then it sells off. Or let's say vice versa. It takes out this one and gives the entry technique but leaves this liquidity pool open. That happens too. We know that because of the Asian session library. We've seen this come in so many different fashions so far. So many different scenarios. Play it forward. What are we looking for? A fair value gap. And look, just runs up. Runs really up. Runs really fast. A fair value gap that breaks a swing low. So we're waiting. We're waiting. We're waiting. Waiting. There. Boom. There it is. There goes the entry technique. Fair value gap. Running right through a swing low. I love this entry. I'll always show this entry because it's what I do. I'll wait for price to trade right back into the discount side of it, the bottom side of the fair value gap where it ends. And we're looking for a 1-to-1 scenario. There we go. Notice where the entry technique is forming above 2 a.m. Also the weekly open down here. This line here is a weekly open. The projection of our 1-to-1 scenario for 15 pips as well is taking out the clean lows right here, where retail traders are drawing that silly trend line, trend line bounce or whatever they want to call it, it's going to get eaten up. Play it through. Now we're in short. We hold. Not every entry is going to be perfect. You may not get the entry that's going to be right where it turns. And there we go. TP hit. Yes, it doesn't look very clean as you would want it to. Price comes down, hits it, and then sells off. You will get conditions like that. Trust and believe. You will get a lot of events where price does respect that entry technique that you've taken or that zone of where you're going short or long in. But they're going to be plethora of times as well where price doesn't really adhere to that entry idea. And then you have drawdown. That's the whole reason why we use a stop loss. Because if that was the case, if we knew that price was going to respect this fair value gap to the T, why would we even use a stop loss that's this large? We would probably use the stop loss to the point where the fair value gap starts, right? The candle that starts the fair value gap. So meaning this candle here. Get this back on the chart properly. So there we go. So we got a London kill zone model idea. Same idea. Nothing changed here. Nothing changed. Purge buy side, went back down to sell side. It's not flashy. It's not the most sophisticated. It's not the most fanciest idea. It's a very simple model. I'm telling you, you can teach a child this. You just need repetition. You just need practice. You can teach anybody this at any skill set. Whether you're just a beginning trader, whether if you're a trader that already has a lot of skin in the game, you can learn this. You can learn this. And I love that a lot of people can use it to find very simple ideas intraday. It takes a lot of the confusion out the way. It takes a lot of confusion out the way. Look at the idea. We're selling above the weekly opening price. There we go. So let's go into our New York model for this day. So we got 7 a.m. You're going to notice this as well. Remember, pay yourself too. Just because this trade idea was successful does not mean it's going to be the same way for every other model or every other scenario. Just because you had a winner here does not mean you just ditch all that you have. You need to pay yourself when the time comes. Pay yourself. Do not just think that everything is all peaches and creams and you don't have to scale out, because the price could easily have gone down, hit 14 pips, maybe 14.5, maybe even 14.9 pipettes. Didn't hit the 15 pips to trigger your TP, that stop order, and then turn back around. You would be upset. You would be livid. Pay yourself. Stop getting too greedy. 5 a.m. to 7 a.m. It's the same idea. Take this. London lunch and kill zone. So 5 a.m. to 10 a.m. And there's a lot of New York models that formed this week for GU that was successful. It's the same thing that you guys see with the Asian session model. Sometimes it's back to back to back to back winners, and it feels good. And then sometimes it's back to back to back losers. We all have been there, and people have to be transparent about it. Everybody talks about the winners, of course, but nobody talks about the losses. I would assume that my audience understands, right, and is rational and thinks to themselves, since intelligent enough, you guys are definitely intelligent beings, that no model is 100% successful. And every trader has been there before when they're losing back to back. Don't even mention the traders that are trading 100 trades in one day and blowing accounts. They're losing consecutively, you know? But even with good risk management or a good model in general, you will find those days where you're losing back to back days. We all have those days. We all have those weeks. We had that last week with the Asian session. Last week was not the last week of February was terrible for the Asian session model. Very terrible. Let's go to 7 a.m. here. So notice how this is not a swing high, so we wouldn't take this. So instead, we would take this. Take the highest high of the session. Take this swing low. So I'm gonna move a little faster because all these are, it's just repetition at this point. Just good practice. 7 a.m.'s opening price. We're waiting for price to purge buy side or sell side. Got one more here. Where are we? Now the chart's getting a little messy for me. Like this is messy to me. Even though there's not a lot on my chart, this is messy. Goodbye. Goodbye. And goodbye. Clean it up. I want to be able to see what I'm looking at. Always. We're above the weekly opening price still. Notice how price going into London lunch, it tags right into Sunday's opening price and then rallies away from it. Went cheap for just a second, then runs back up into a premium. Let's play it forward. Price comes down, takes out sell side liquidity here. Now, would I be looking for the buy condition? Not really. I wouldn't really want to look for the buy condition because we're above the weekly opening price. But let's just scale down to a 1 minute time frame just to walk through it. G was really good last week, like amazing, amazing one. Now let's just see what happens here. Just watching it, right? That would be the entry technique. Let's just follow along here. Let's follow it as if we were just looking at it in this natural state. Besides hindsight, that would be the entry technique because it just took out the 15-minute swing low. It created a fair value gap that runs to a swing high formation right there. So this would be the entry. Let's play it forward and see how price reacts off of that idea. Gives some precedence to it, but then finally fails through and completely sells all the way through. So you can see here for this New York session idea, we didn't necessarily get the entry that we were looking for or the purge on the buy side, but we had clean highs and we had fails of break of highs. So there was definitely some type of PD array that you can use here. May not be the entry that I prefer after getting a break or failing to break a high, because the way I'm using the steps, right? Step 1, step 2, step 3, you can incorporate a mixture or the same idea. If price fails to break a swing high and gives you a mitigation and then also gives you a fair value gap that runs lower, you can do that too. You can see it happened here. Price fails to break this high, comes up, makes a lower swing high, breaks down. When it breaks down after this point here, you can see that there's a fair value gap that runs through a swing low. So you have the mitigation here. Not the breaker. Doesn't break the high, then comes back down. It fails to break that high. Here, you got this idea. Price going up, down, coming back up, failing to break the high, comes down again, trades back into that low point again, right into your mitigation, and sells off. So I'm just showing you it doesn't have to be just one entry technique. I'm only doing it this way because it's more simpler for me, and I like to just stick to the same one over and over again. When I start hopping around and picking different entry ideas, it just puts a lot more stress on my brain. I don't want to stress. I just want to trade, bro. Who wants to stress? This stuff is already stressful in itself. I don't want to stress, man. And moving forward in my trading career, that's all I've been trying to stick to. Less stress, less stress, less stress, bro. It's bigger than the money. It's bigger than all this. I just want to be able to trade comfortably, less stress, less anxiety, less nervousness, less FOMO. If it ain't there, it ain't there. Next day. I have other days, I have other months, I have other weeks I can trade. It's not the end of the world. It's not the end of the world. With a little bit more patience, you can see success. But when you start rushing the success, then you'll see the trials and tribulations start coming. All the hurdles start coming your way. Whether it's from a market standpoint or once it's from an operator standpoint, you looking yourself in the mirror. It's because of you. You wanted to rush the process instead of waiting for the model. So that is the New York session on Tuesday. So we can see, does it run that 15-minute swing high or the highest high we had on the 15-minute here at 7:15, but it fails to break that high and still breaks down, gives that same idea and falls lower. You can even see it here, gets lower here, trades back into it again, and then drops down again. It only comes with experience. You start to see the market in very simple structures or simple patterns, I would say, right? Simple structures you will learn to break it down and how would it look in your head. This when I paint it in my head or forecast it in my head, it looks like how I'm drawing it here. These ideas. That's what I look at it. I'm like, okay, it's gonna do this, and do that. That's one scenario. Or it's gonna do this, then go down. Fair value gap is somewhere around here. That's what I like to do. I like to paint out all the scenarios in my head because I know it's either one or two ways. Either gonna be a breaker or it's gonna be mitigation. It can't be a third way. There's no other way, guys. Literally no other way. It's either going to be a false break every single time, or it's going to be a fail break every single time. There's no other third scenario. So if you know all the scenarios, there shouldn't be a lot of things that you should be worried about. You should only be looking for two certain things to happen, given the context of how you're setting up your liquidity pools. 15-minute time frame going into the kill zone. I love to do it this way. Let's go into Wednesday. For anybody that's just joining us, we're just going over the weekly range review. We're going over to see what models we had throughout the week during the kill zones. And we're looking at how we utilize the dead zones to find trade ideas to trade the live sessions, aka the kill zones. Let's go through this a little faster. So we got swing low here. So at any point, if it's confusing, slow me down because I'm just gonna go full into it now. This is not a swing high, so this is it here. Notice we're below the weekly opening price. This dash line is the weekly opening price, so we're in a discount. Here's the open. That's 7 a.m.'s open price. Oops. Play it forward. See what happens. Price comes down. Price comes down. Down again. Purged. What do you think is happening here? What do you think retail traders are doing on these three large candles down? Can anybody answer that question? What do you think in those 3 15-minute candles that we're seeing here? What do you think retail traders were doing? Retail traders were doing? Selling. Absolutely. Just chasing. They just they don't wait. They just want to jump in. No, time to sell. Wait a second. We purged sell side. Good. Let's go down. Great answers, chat. Shout out to the chat. We're waiting for a fair value gap that breaks a swing high. Yes, this is great pips to the downside. Many people will argue, right? And these are people that I wouldn't have the time to argue with because I just know they don't know what they're talking about. People will sit here and say, "But what about this move down here? What about it? We weren't even looking at this. We're not concerned about trying to catch that. We're actually looking for something else. You're waiting for this to break first, and then we see some type of setup. Play it forward. There it is. Fair value gap. Swing high. 1-to-1. There you go. You got your lunch, right? You just stalk the setup. Lunch is about to occur. Let's see if we have dinner. Yep. We just got there. Look at that. Look at that. This, I could, just looking at this, I like to formulate things in my head. When price got right here, it's crazy. Just to 7 a.m. It's so crazy how this market is designed. Whoever coded this thing is a genius, bro. Got to 7 a.m. right before we would have got out to take profit, right? Traders that did not take profit here. Traders that did not take profit all the way up here. Did not take any profit. And they came back to their chart hours later or minutes later after, right? And they saw this decline here. Man, the feeling that they have, that gut feeling that they have, bro, nothing compares to that probably. You got to pay yourself, or you got to be attentive to this, or you put in some measures into this. What I like to do personally, this is just advice. Since I like to scale out at 10 pips, this is what I do. I would measure up 10 pips, right? I measure up 10 pips. That's good enough. And I would place a horizontal array or a line here at 10 pips. And what I do is I place an alert right there. Boop, I place an alert at 10 pips. So when 10 pips is hit, and I'm probably doing something else because I've already got my entry and I can kind of relax a little bit, or read a book or, watch a YouTube video or chat to people online or people in the channel, answer questions, etc., etc. The alert snaps you right back on. I'm like, oh, snap, 10 pips. Yo, D, jump back onto your MetaTrader, jump back onto your trade locker, jump back onto your trading view, whatever platform, take the profit right there. Cool. Take the profit, move on. And that's it. You gotta be proactive. You gotta be proactive. You can't have things just have no jurisdiction or no, what's the word I'm looking for? You have no you have no responsibility. Take responsibility. That's the main. Just take responsibility. You need to be able to be prepared for it. Be prepared. Piss poor performance promotes piss poor pain, and piss poor pain promotes whatever. Something my dad used to teach me when I was younger, like the 12 P's or something like that. You want to be prepared for all scenarios, bro. You don't want to be slacking. You want to be on point. You don't want to be slacking, but hold it through if you have confidence with it. Of course, TP hit, done, bro. You're done. That could be 3%, bro. I like it's crazy when I talk about this. Some people think it's like the numbers are just like not adding up. I'm like, yes, it is. If you have a 10K account and you risk 3%, right? Whatever that lot size would be, granted, when you calculate it, right? For the 15 pips up here and the 15 pips down here, 1-to-1 scenario, 3% of that of 10K would be $300. This one trade, if it was successful, you won $300 in one trade. If it is unsuccessful, you lost $300. It's not the end of the world. You could definitely make that back up. Let's say you're even, less tolerable to risking more, right? You want to risk 1%. That's only $100. $100. One Benjamin, bro. One Benjamin. You win that trade, you win $100. You lose that trade, you lose $100. It's not the end of the world. But then it becomes a problem when people are risking 6%, right? 4%, 5%, 8%. That's where the problem occurs. You burn through so much equity. You burn through equity. In a couple trades, you're done. It's about longevity. How long can you stretch your equity so that you can adhere all the bumps and all the potholes and all the ditches in the road so that you can find smooth road, right? Or smooth pavement so that you can find easier setups for yourself. How long can you adhere to that? Can you weather the storm? A lot of traders can't weather the storm because they don't have the principle of psychology. They're lacking that. It's FOMO. I know I don't know why we do it. I don't know why anybody would want to trade. I know the answer to it. It's rhetorical, of course, but man, when you see how many people fail, you just kind of are discouraged. Last New York model for GU. GU was a banger this week, bro. Not even gonna say anything. Just gonna mark it off. 7, 10 a.m. Lowest low. Is it sell side? Is this swing high? Yes, it is. Swing high. We're below the weekly open. Are these equal highs? Who's lower? Who's higher? This is higher. Swing high. Cool. 7 a.m.'s opening price. Wait forward. Sell side taken. Stalk the setup. We're like a lion stalking the gazelle, right? We're like an alligator stalking the zebra or whatever is trying to come into the lake, right? We're waiting for them to step their foot right into the puddle. They don't realize we're there, and we grab their leg. And that's lunch every time. That's dinner every time. That's all we're doing now. Wait, boom. There we go. We're stalking it right there. We stalk the setup. It occurs right there. Boom, done. And it's always nice for it to happen very early in the session, so you're done. Here it is. That's the swing high. So I wouldn't consider these swing highs here. It's not a swing high because if you look, these two price points are a double top. I said this before. I don't know if later in my career or months from now, I will make the exception for this to be a valid entry idea, a fair value gap that runs a double top or a fair value gap that runs a double bottom. I don't know. I have to study it a little further, but this is where I'm looking for a swing high that runs that one-to-one scenario. Fair value gap is happening, or the entry technique is happening in a discount again. Zoom out. It's also happening below the weekly open. And we got a lot of projection to the upside. Play it forward. TP smashed. Like, come on. All buy side liquidity pools rated. And then you almost look like a fortune teller because you knew exactly where price is most likely to go. Other people don't know. They draw trend lines. They draw trend lines. So subjective. You're being objective. You're already light years ahead of retail traders. You know exactly at what price point. You can literally click it too. You can see what price point you expect price to draw to. You can call it to the T. Right? And when you go public with some of these things, people are just like at all. They're like, oh my gosh, how did you know? Now you know. Now you know. Someone said in the chat, Juan, I've been working on being patient to see a clear entry. You're right. So just with repetition, I've been improving my entry. Great, man. I love to hear that. And I'm glad. It's all about repetition. How many times can you see the entry? How many times do you have hours underneath the belt seeing the idea over and over and over again? How many different ways have you seen it? Look at this idea. Look at this New York model that we see here. Drawdown. And like it's a different fashion. It's the same idea. Purge, right? Purge, revert. Cool. Done. Sell side to buy side. Very simple idea that we all understand. But sometimes we can see that look how price was just really respecting this zone. And there was news. I totally think there was news. It's definitely there was news. Was this Thursday? Wednesday? It's Thursday. Yeah, there was news. It had to be news. Yeah, I knew there was news. So price just runs higher. And it was waiting for what? The news event. Right there. The news event. And just thinking about the news real quick before we jump into the next pair. News event drops at 8:30. Very typical for the New York session. It always happens at 8:30. All the data comes out at 8:30. 8:30 is a very significant macro time period, right? 8:30 to like 9:45. I know there's other macro time periods people use. Don't quote me on the times because I don't use the macros personally. Price runs up with a lot of speed and injection here, right here, on that 1 minute candle. And I always like to say it like this because it's just something that I know other human beings are physically doing and emotionally doing. They're emotionally invested, and there's FOMO, anxiety, and greed. It's a whole paradigm that's going on in their head. It's just bouncing back and forth. The same emotions and same feelings are recollected over and over again at 8:30 when this news drops. This large candle, boom, large cycle. They're a dog. It's like I was the market maker, right? Or I was the owner, right? And the retail trader is the dog or the pet or whatever you want to call it. And I got its squishy toy or whatever you want, whatever toy it likes, a bone. Let's call it a bone, right? I start waving this bone that the dog likes so much, right? And I throw it out there. This is the bone. This large candle is the bone. The retail traders are the dog. They chase. They're chasing this. They're salivating at this point. They're salivating. They're drooling. Oh my gosh, bro. That's when you get everybody to chat. Yo, did you see GU? Did you see GU? I'm going long. By the time they go long, most times than not, I would say almost 10 times out of 10 times, they're going long up here. They're going long at the highest point of that candle. They didn't get the long down here. It's way too fast for them to catch it. They already went long, and they're really expecting another large candle. That's what they're hoping for. Sometimes they are right. I always like to give them the benefit of the doubt. Sometimes they're right, and another large candle happens to pop up and push higher. And if you're lucky, you're able to get out with some profit, especially if you're risking heavy too, right? At this point, a lot of people are risking 4%, 5% because they're trying to catch a big new leg higher. But we know that the market, we know that the market will likely pull back. Just the nature of the market. What happens? The next candle, hard pullback, right? Or even the candle here. Let's keep playing it forward. It looks like the market's not going anywhere, right? For these 3 minutes here, 1, 2, 3. Retail traders are in a world of pain. Psychologically, there's psychological warfare going on with themselves. Everybody that went long here, they have to now battle their demons in their head, thinking to themselves, should I hold my longs because I'm going to get this or am I going to just take the margin call and blow my account? That's what they're battling with at that time with themselves. Play it forward. Accounts are wiped at this point. Gone. Everybody that went long here, accounts have been wiped in 4 candles, 4 minutes. You gave up your whole account. You blew your funded account. You blew your live account with your broker in 4 minutes. Come on. Got to do better than that. Longevity is marathon. Retail traders already know that they're going to get smoked and they admit defeat. But those that are informed, same entry idea happens again. Fair value gap, a little bit of it's in a premium, but the majority of this fair value gap is in a discount. Same idea. Look at that. Fair value gap. Or vice versa. Like I said, it's either one or two ways. It's either going to be a breaker or it's going to be a mitigation. Just based on the 1 minute structure that we have here. Let's say looking at it in 5 minute probably will look better. We got this swing low here. We got this swing low here on the 5 minute. So with that in mind, right? We had a swing low here. It's most likely this one here, and a swing low here. The highest point between these two swing lows. Higher. Price goes higher. Runs right back up. Play it forward. And this is minutes after the news has already dropped. The news dropped at 8:30. But look what happens after 8:32, 8:33, 8:34, 8:35, 8:40. Look what happens. Nothing. A whole bunch of nothing. Because they got retail traders underneath their grip. There's a casualty occurring here. They're running orders, man. They're running orders. And there we go. Buy side, buy side. Right there. Every time. And it's a really good feeling. But you got to stick to the model in order to get to that good feeling, you know? And that is GU. So we went through a couple of examples, plethora of examples. Last pair we're going to talk about before we move on to our next model or our next topic. And our next topic is pair filtering process. So you're going to see how I personally like to filter out what pairs I'm going to trade for the next month. Sometimes it can't be the same pair because that's the only one that falls and suits the filtering process the best. Take off the news events. And luckily, it's only 2. So we're going to get into more London ideas here. So we got London model on Tuesday and London model on Wednesday. Hopefully, I got my water bottle in here. Hindsight before we jump into it. Look at that, man. Come on. Doesn't get any better than that. Best buys, discount. Best sell Friday. Whew. This last week was very interesting. Like S&P 500, NASDAQ, gold, bro. Everything was just crazy this week. Someone said in the chat, do you always leave runners to take buy side and sell side liquidity? Not always. No. Not always. I would like to, but not always because sometimes price comes back down and stops me out. Even when I have a trailing stop, price comes and knocks me out the trade. And I have to live with that and I move on. But when I do get the opportunity to trail a stop, I trail it. And if the market does grant the willingness to continue to give me more profit going into the next day or the next couple hours, I'll take it. Yeah, not every case scenario where the trailing stop always works. The market is always going to come back down, seek new liquidity, then run back up higher. It's going to run my stop. It's not like they can see it. Some people argue and say, in their belief, in their ideology, they believe that the algorithm or the market makers can see your stop, which may be true. I don't totally care if it is true. It is what it is. And that's what I sign up for. That's the game. We all sign the contracts with our brokers to allow for that stuff to happen. Slippage, large spreads on us, et cetera, et cetera. So we're playing their game. And that's how it is. But I always try to get a runner if I can. If I can't, take the full 15 pips and move on to the next day and call it a done deal. London model. So we're gonna interact with the chat once again, just to engage you guys. What is this time period here from 12 a.m. midnight to 2 a.m.? What time period is this again? Anybody in chat, give me a few words. I know there's either two terms people are gonna send me. I'll give you guys a few seconds. Anybody can say it before I type it out. Asian session, close, close. That's a close one. Asian session, what? There's something missing to that. Because look at the time period. It's 12 to 2 a.m. Begins with an L. There you go, Pablo. Absolutely. Asian lunch. Not Asian model. No. This is going to be the London model that we're going to go into. So this is the Asian lunch. This is from night to 2 a.m. So that's the Asian lunch. So 12 a.m. to 2 a.m. We're just looking for the liquidity pools that are going to be residing in here. So I'm showing you guys the steps. And I'm walking through all the steps with you guys. 15-minute time frame swing high. That's buy side. And then we got the lowest low at 215 right there. We got the opening price for the London session or European Open, right? Frankfurt Open. And play it forward. Price takes that out. Retail traders are going short. They see large candles. They see a sell-off going into the kill zone already. They don't even understand that they're going to most likely be in a world of pain because the market is going to go through power 3, accumulation, manipulation, distribution. There's going to be some type of accumulation phase, a manipulation phase, and a distribution phase. It's all fractal. Sometimes you do have those moments and times where the kill zone opens and it just trends in one direction. We've seen that many times in the chat when we do the Asian session at night, and I send those screenshots as the Asian session progresses, and we see the Asian session either just trend up the whole session for the entire hour, right? Or all hours of the Asian session, or vice versa. We'll see sometimes that the Asian session just opens and just continues dropping the entire way. Nothing you can do. It's just that case scenario, that Asian session or that kill zone happened to want to distribute lower, right? Or expand higher. And we can't do nothing about that. But I always like to just take the default that the market is going to bring a Judas swing and then look to gauge to go in the opposite direction. That's my default every time going into a kill zone. So at this point, let me just play it back one. We're going to go on the 1 minute time frame. That's that low broken. Now we're waiting for a 15-minute swing high broken and price looking to run higher and tap into that fair value gap. We're below the weekly open. That's the weekly opening candle right up here. Sunday's opening price. Play it forward. We're waiting. We're just stalking. We're stalking. Stalking, waiting, waiting, waiting. It might take a while sometimes. Sometimes it happens at the end of the session. Sometimes it happens very early into the session. We would obviously like it to happen at the beginning because time is money. But hey, what are you gonna do? And you zoom in, make sure I didn't miss it myself. Just double checking. Here, yep, right here. So you got a fair value gap. You gotta have a keen eye too. Sometimes it's not the swing highs that are really close here. It might be a swing high that's already been printed on the other side of this turning point here. There you go. That's that swing high, fair value gap. We're gonna look to find a long setup here. Nah, it is 100%. You somebody in chat said you Swiss franc is an annoying pair. It's in my experience, bro. I don't trade this thing, bro. I'm just using it just as an example to show you guys. Like I always want to change it up every week, different pairs. Like last week we did like AU and UJ or whatever. I just wanted to change it up and show you that it's not all different pairs. But you Swissy, bro, like, bro, don't trade this pair, bro. Do not trade this pair, bro. This pair is disgusting, bro. Oh my gosh. And the reason I think it's very disgusting is because Swiss franc versus the dollar or dollar versus Swiss franc, very competitive. A lot of people will argue that Swiss franc is better than the US dollar. Way better than the US dollar. And I think so too. The Swiss franc is a very strong currency pair versus the US dollar. It's much better, bro. A lot of and exactly. Thank you, Pablo. Somebody in the chat said that it is way better. You can go do your due diligence, quick Google search, bro. You can tell that the Swiss franc, they know exactly what they're doing with their fiat currency, bro. The Feds, they have no idea what they're doing with their money, bro. Price taps it, it's played out, see what happens. Played all the way through. Drawdown. Ooh, some drawdown, man. Always not the best feeling to feel that, but let's watch it play all the way through and TP. Yes, sir. Right? There you go. So, very simple idea. This is London. So we're not forgetting. This is London kill zone. 2 a.m. 5 a.m. There you go. Exactly. They don't print money out of thin air, bro. Like all these other countries, bro. We're about Pablo. I hope you stay. I hope you have time to stay through this, bro. Bro, we're about to talk about a lot of that stuff at the end, bro. Trust. We're about to start talking about gold and all that stuff too. Not saying I'm the most versatile and up to date person on all these things. I do my due diligence in my readings throughout the day and try to stay up to date with what each country is doing. But bro, Swiss franc, they got this, bro. They got it together, bro. I'm telling you, they got it together. But that's the London model, right? Cool. Moving on. Next London model we had for the week. And notice it happened below the weekly open too on a Tuesday, ideal trading day. So the most volume that occurs during a trading week is going to happen either Tuesday, Wednesday, or Thursday. Not to say it wouldn't happen on a Monday, because it could, but midweek is normally where a lot of money is being made. A lot of money is being made. Straight plate forward. Man, the world is in distress right now, bro. And we'll talk about it, bro. But like, we'll get there. We'll get there. We'll get there. Like I said, I'm not no financial advisor or some type of accountant or a hedge fund manager. I'm none of that stuff, bro. I'm just your average dude that just I just try to stay on point about what's going on in the world, bro, and what's going to impact me and the future family that I'm going to have, bro. Like this stuff is important. So, got to protect the bloodline somehow. 2 a.m. here. Word. Give me 1 second. I just got to shoot a text to my little brother. He just landed in the plane somewhere. Make sure he's good. All right, bro. Be safe. Be safe. All right, back to business. All right, swing low. Here. Swing high. Not swing high, but and high. London open. Come on, trading view. 2 a.m. Play it forward to see what happens. Buy side hit. Let's play it forward again. Now it gets above the weekly open. Right now it's above the weekly open here in this scenario. Let's go back to the 1 minute. Let's check it out. Got some clean lows, right? Clean lows. Those that are familiar with ICT, when he was teaching you guys in that core content, what should you be looking for? What should new traders be looking for? Speed, breaking of clean highs, breaking of clean lows. The same things are still applying here, even if you're well versed with trading. Those core foundations, bro, still apply to a veteran trader. Play it forward. We're looking for a fair value gap. There it is. There it is. Too fast, too fast, too fast. Right here. Fair value gap. Run to swing low. There it is. It's not this swing low. Not this one. Not this one here. Look at it. It's not inside. Zoom in because I'm blind. There it is. It's not that swing low. It's this swing low here. That one right there. Go short, 1-to-1 scenario. Now you're not going short in this one. I would let this one slide, but you wouldn't be going short above the weekly open. But it does get above the weekly open at said point and then creates the entry technique. It's happening above 2 a.m.'s opening price. Play it forward. Price taps into it. See how price plays out. Ooh, look at that consolidation for the entire session. The entire session was consolidation. So you left this session, you left this kill zone and drawdown. Not a good feeling, of course. But then you leave it going straight into profit. New York session most likely is going to finish this off. Unless it stopped. No, no, no. Let's see. Yeah, it's definitely going to go down. That reaction off that Sunday's opening price, strong, strong reaction. And oh, TP, there you go. There it is, TP hit right there. Boom, right off of Sunday's opening price. So it was threading the needle the entire time here during London, threading it, threading it, threading it. It went premium, discount, premium, discount, premium, discount, premium, or fair value, and a little bit of premium, and then back down. So there goes your weekly range review, London and New York model. We're not going to talk about the Asian session model because I already have a library on that for you guys to view that. But we just do the weekly range review so we can get a scope of what you could be looking for. Very simple every single day during the week. Remember, risk properly. I'm not telling you it's guaranteed. So we're going to move on to our next topic. And our next topic is going to be our pair filtering process. And we're going to be talking about a couple things here. So pay attention. We're going to be talking about interest rate differentials, seasonality, large range versus small range via monthly chart, right? Not daily, via monthly chart. There's a difference here. And then last year's movement for that pair, meaning what happened in March of 2023 is probably likely to happen in March 2024 too. It's a possibility. So we like to look at those things too. So let's take a look at another chart. So this is IPTA from, this is DXY, this is IPTA from for February. So you can see how price reacted around certain levels here. But we're going to clean that. We're going to clear this off for now. Get back to that. Definitely got to remember to add that to the data range library. The whole idea of the pair filtering process is to pick the prime pairs that are most likely to move. So the general premise of this is pairs that give a monthly candle. So let's start on a monthly candle. And this is something I learned from Larry Williams, and it's making my pair selection even better because it just gives me an edge. When we're on the monthly chart and we see that the candle or the month that we're currently in is most likely going to close small, meaning it's smaller than the previous month, that means going into the next month, we may have a possibility chance that this candle is more likely to give us a dynamic range expansion or going to a large range cycle. It's the same idea that I show you guys on the daily chart. One day the candle is very small, and then all of a sudden the next following day it's very large. So that's what I like to use. So the monthly chart, large range to small range. When it comes down to selecting the pairs after that, I'm going to be looking for seasonality. So I'm using that in tandem as well. So seasonally, I'm looking for the pairs where the correlations are following the market code. So if dollar is supposed to be going up or down from March, other pairs seasonally need to show me that it's going down or up or opposite. So let's take a look at the seasonal tendency for March. So DXY for March, you can see there's a slight rally and then a strong decline. Before we start talking about seasonal tendencies for a minute, I want to just give a disclaimer. You're using this as a treasure map. It's not guaranteeing you that you get to the treasure right at its coordinates, right at its y and x axis, but you may get placed in the vicinity, right, in the area, really close, and you might have to do a little more homework and due diligence and searching in the area to get to the actual treasure. Or the map itself is completely nonsense. That is true. You might get a treasure map that's completely marked up really wrong. Seasonal tendencies can not be correct for certain months sometimes. Sometimes they are perfect. Sometimes they're spot on. But there are some months where the market does not follow the seasonal tendencies. Do not bank on the seasonal tendencies as the end all be all to where the market is going to trend. Just because you see that the DXY shows a sharp, a quick incline going into March doesn't mean it has to do that. Not necessarily. It could decline the entire way in March, or vice versa. It could probably just continue rallying for March. So keep in mind that the seasonal tendencies is just a treasure map or some type of roadmap to get you closer to the answer, but don't rely on it. Use other intermarket analysis, use interest rate differentials, and we'll talk about the whole scope. So we see March is generally bearish. So, okay, interesting. It's bearish. So that means we should be seeing for any currency pairs that are directly correlated or inversely correlated, we should see it going opposite. So we should see March is going up for either EU, AU, GU, NU, Swiss, CAD, etc. We want to see that gold, etc. We want to see those things going up. So that's what I'm looking for. So when I looked at the pair selection, I saw that Aussie right here at said point, it was going down. But then at the end, it showed a sharp, a small incline. So I was like, okay, that could pass. So I took that as one. So that's how it got onto the poll that we had for the Telegram channel. So for the poll, it was gold, AU, and EU. And another reason why, because AU, let's just go to AU real quick. AU's last month was a small range candle compared to its previous month. So January was large. February, not so much. Just looking at it, look at how it's forming. It looks like it's creating what? A swing low, right? A swing low formation, trading into what? Maybe bullish order block theory, fair value gap, probably looking to go higher. But we're not going to get too specific in those things, right? So that's why I selected AU because I said, okay, it's a small range cycle. March is most likely going to give us a dynamic large move. It could give us another small candle, but sooner or later, maybe April is large. But now I'm just predicting and now stalking AU because it's in a small range cycle. Because I know sooner or later it's going to explode dynamically. So it's on the watch list. So great. Another reason why we selected gold. Let's jump onto gold real quick. Gold last month, February, tiny candle. Tiny candle. Small range candle. March, we're looking for it to expand. And already, banger. It's jumping right out the gate. Check the daily chart. It's already flying for the month. Just started. You guys saw in the chat, I was able to catch a long right at the opening price of this candle, go longer. Look at the annotations on this because we're tracking EU for the month of March. Small range candle, and it's also down. That's crucial too here. So with trend, that's a good thing. I'm speculating. If it's trending higher, it's good that we had a down month. Let's trade away from that down month, right? So we had a down candle, and seasonally as well, it was a small range candle. So I'm expecting March to be large. So that's our large range, small range. Let's get that out the boat, right? That's done. Seasonally, we saw gold, not much, right? Not much. Had a small decline and then a small rally. So I was like, okay, I like that. Good. It's not that it was declining the entire way of March. So that's another reason why I liked it too. Euro, right here. Euro, whoo, strong movement to the upside. So it's like, okay, this is definitely getting on the list. I need to place this on the list because it's following market code and it's showing it very strongly. DXY is dropping while EU is rallying up. So I like that. March is showing great market correlation. They should be going opposite directions. So that's good. Another reason why EU made it on the list for sure. At this point, I look at the interest rate differentials and I want to compare. Where is it? Where is it at? Where is it at? Right here. There we go. I want to compare what pairs have a strong interest rate differential. So it's not GU. GU didn't make the list. Not saying it can't be traded, just wasn't ideal. The rate between the Feds and BOE, Bank of England, is too close to each other. They're literally a 1.5. Sorry, not 0.5, a 0.25, a quarter away, right? A quarter of basis points away. So I didn't want that. It's two strong currencies banging each other head to head, and they most likely aren't going to give up. I didn't like that. But then I go down to the ECB, right? The European Central Bank, 4.5, 5.5. So we have a whole almost full point difference. So there's an interest rate differential. So I like that there's an interest rate differential. So there's a strong versus weak. The fact that the Feds have a higher interest rate versus Europe doesn't necessarily mean the European dollar is going to dramatically be devalued. That's not the case. I just like the premise and the whole idea that there is a interest rate differential in general, and it's a lot larger than the other majors. Same thing for Australian dollar, even larger than EU, right? The interest rate differential is a full point and a quarter away more. So that's another reason why it made the list as well. These markets are most likely primed to move because it's a strong versus weak. There's that relationship instead of strong versus strong. So that's why that made the list. Besides gold, of course, with gold, there's no interest rate on gold. I can't find no interest rate. Gold is not a part of a central bank's, monetary policy. But gold in general should be moving opposite to DXY. So another reason why I put it on to the list. Going back to the chart though, with all that in mind, we're going to be looking at the daily time frame, and we're going to be looking at EU for the month of March. So this is the IPTA look back data range. This is what it looks like. This is how I start every single month. Nothing changed. People ask me this question all the time. Deontay, do you take off the IPTA data range from last month and start a new one? Yes, I do. Does that mean I have to completely forget about the other levels that are probably still intact from February's and January's? No, because those could still be significant levels. It's not as if the algorithm just forgets these levels. It's not. We're using a certain data pool to predict future price action. We're looking back 20 days or 20 bars. The reason I'm saying 20 bars is because when I use the tool, I hit shift, right? I hit shift, I click my screen, and I scroll over. It's saying 28 days. I'm still a little confused about the whole idea. Somebody could probably um give me the rundown on this, but it's 20 bars. It's probably including weekends or whatever the case may be. I'm not quite sure. But I know we're on the daily time frame, and each candle represents one day. So it's 20 days. There we go. 1, 2, 3, 4, 5, 6, all the way to 20. That's 20 bars. That's why I'm using that there. Go back another 40 and 60. So that's our range. We find the highest high and lowest low in each one of those quadrants, even if it's broken in future price action, because it can still be used as a PD array as an old low or old high. It can still be significant to the future price action. And we've seen that in multiple examples. We really like the ones where there is liquidity below it and it's unbroken. There's a swing low here. There's a swing high here. There's a swing high here and a swing high here. So we can have some draw, some purges, and reverts to certain levels. And even in between, we also have swing highs that are unbroken too. So we still have a lot of liquidity available to the marketplace here. It's not that just this level here is more significant than this swing high here. This is still significant because price can easily draw to that one here and this one here. Not that I want to note off everything here. I just want to keep the chart clear and simple for you guys. Now, thinking about this, right? This is where you got to really put on your thinking cap. You got to be very intellectual here, right? You got to understand how a bullish and bearish month unfolds. What are the characteristics to it? This is why I have that video on my YouTube channel. What does a bearish month look like? And what does a bullish month look like? They have very particular characteristics. They're just inverse to each other. When it comes down to a bullish month, you're going to see these conditions. You're going to see a swing low form below the monthly opening price. You're going to see, and it could be multiple swing lows as well. You're going to see a fair value gap, most likely a busy to the upside. There's going to be at least one busy, a very strong busy to the upside to this bullish month. Secondly, you're going to either see a raid on a sell side liquidity pool and price running back higher, a false break narrative. 3 or 4, after down days, you're going to see buying occur. And yes, Jeremiah, I can give you the website to the interest rate website. I'll put it in the chat after. After down days, you're going to see price dynamically want to get away from it. Sound logic. Now, everything I just said is vice versa for a bearish month. If you're still confused, I have a whole video on my YouTube channel. You go underneath the playlist. I think it's the 2023 playlist by Forensic Forex Mentorship. And you'll scroll down, you'll see bullish and bearish month characteristics. Click that video. It will give you a full breakdown on what you should be looking for and how it should most likely unfold. Now, think about the scenarios. If this month is going to be bullish, the very peculiar scenario that we can get is price opens here, little pullback, and price just continues going higher. That is a very interesting scenario. Not the most ideal one. We would still flow with it. We would still follow this scenario because we do see months that happen to form just like this. The same way we could see a kill zone just trend in one direction. 8 p.m. opens, Asian session just trends down the entire way to 12 a.m. or it trends all the way up going into 12 a.m. It's the same thing that can happen to a monthly range. It can open and just trend the entire way up or open and trend the entire way down. There's no large manipulation or huge Judas swing on the retail traders. That is just one peculiar situation that I really don't like to see because I want to get the best buy. I want it to drop below the open and then run higher. I want to position myself below the March opening price if I can. I always want to opt for the best situation possible in the bullish scenario. As you guys know, I'm banking on bullish EU, and we'll talk about and discuss why and how I've arrived to this speculation. Price can either tap this 40-day if the look back low, create a swing low formation around it, and then go higher. That's one. Another idea, price can come down, take out 20-day, and even tap into the 60-day low, right? Old low. Take out the 20-day low, and then go higher. This is the Judas swing. This move down is to get everybody on the wrong side for the month. Then second week, third week, fourth week, price is already doing its range expansion to go higher. Then we look to see price take out the 20-day high or any liquidity pools residing above swing highs, maybe even the 40-day high, 60-day high, if we get there in the next 20 days. Now, we may not get there in the next 20 days, right? But we may get there in April. We may get back to these levels in April. It doesn't mean we have to completely tag every single level. It's just something that we expect or anticipating in projection. So that's one scenario. Now, instead, Another peculiar scenario, right? This is probably not likely to happen, but if it does, it happens. Price does this. We've seen that happen before. We've seen, I think it was AU last year in 2023. I don't know which month it was. We were doing the daily tracking. So AU won that month for that month, and it was consolidating the entire month. We couldn't really get a trending environment. It broke a swing high, then it created a higher swing low, but then it fell back down and broke the swing low. It just was back and forth, back and forth, back and forth. Very terrible condition to trade in. Even though we filtered it out, we still happened to run into a pair that consolidated. We really don't want to get a pair that consolidates, but that's the whole point and why we do the filtering process. So we're less likely to have a pair that does that. If we ever do run into a situation like that, we would probably look for a secondary pair to look at and see if it's trending and more dynamic and try to trade into that more. Another scenario that can happen. So let's say it's not bullish at all and it's not consolidating, it's bearish. Price either does this straight down, right? Something like this. Not straight down, but like that. Or price comes up, takes out buy side, then goes lower. That's the scenario we can see here. And in that case scenario, that means it would create a swing high formation above the open in a premium. Price comes up, trades back into some type of SIBI, and then trades lower, or some type of mitigation block or breaker block, and then trades lower and trends lower. So that's another scenario here. That's why I like to do the filtering process and look at the macro and data that we have, seasonal interest rates, and large and small range based on natural price action cycle via Larry Williams. EU is most likely going to be bullish. The reason I say that is because if we look at dollar, do I have another slide up? I think I have. I probably do not have another slide up. If we look at dollar in its recent time and what it's doing on the daily, it broke swing lows and it's creating lower swing highs. Let's just take a look at the dollar real quick. DXY. Not that we're going to mark off anything right now, but just I want you guys to get a simple premise. I said this, I think, right when it broke this swing low, which was 2 weeks ago. I had said, I think the pairs. I said dollars shifting back bullish, and all the XX USD pairs are shifting back bullish. And many people ask, how do I see that? I saw it in the bond yields, and I saw it in the DXY, and the actual currencies that are inverse to it were showing opposite. Right here was where I saw the market change direction. And we also had price respecting this volume imbalance. So another ICTpedia right here, volume imbalance. Swing low broken. I told myself, if a swing low is broken, and if this is two things, false break or trend change or momentum change, right? Trend change. One of the two. That's the only scenario. One of the two is going to happen. It's going to be a false break. Price breaks this low and then it goes back higher. Or price is going to break this and then continue to trend lower. Price creates what? A lower swing high formation here. Right there and then, I said, wow, dollar just shifted back bearish. It's not confirmed yet because this swing candle, its low isn't broken yet. But in theory, it is a swing high by definition. And I said it's most likely going to continue to sell lower. And then it confirmed itself there. And I was like, wow, it sold off. After any up candle, we would look to do what? Sell. So look to sell. Nope, lose there. Another up candle, down. And good eye, yes, Jeremiah. Is this a smash candle? Yes, absolutely. Why is this a smash candle? Because this one candle itself takes out multiple highs. It takes out 1, 2, 3, 4, takes out 4 highs, and it closes above more than 3 to 8 days highs. Price returns back to the low of it. Larry Williams will tell you do what? Go short at the low of the candle. Most likely place a stop loss above that high. This would be a very large stop loss, so it probably would not be a setup that you would want to take. But just looking at it in theory, yes, this is a smash day candle. Good eye. Awesome, Jeremiah. Play it forward. See price creating up candles last week of the month. And this is where we are right now. So the last markup I have on a DXY was this here, and then these swing lows here. This swing low, this swing low, and this swing low. Sell side all down here. I wrote here, price broke a swing high. Is this also the same idea? Is this a false break? Or is this a trend change? Was this a false break the whole time too? And is it really going to gear back to go back long again? Or is this just price running, sells buy stop raid, and then going to continue going short? So far, it looks like it because it ran that high and then it printed a down candle and closed down for Friday. So it looks like that so far. And this is the opening price for March right here. That's the open of March. Price runs above the open and then runs down lower. Doesn't mean we don't return back to the open or beyond it again going into next week or going into NFP. I think NFP is on the 8th. It's going to be March 8th. NFP is going to be March 8th. So be careful that week. But I want to see if price is going to give us another opportunity for DXY to go in a premium and then sell again. Or this is the best sell that we had at the beginning of the month. And price never gets back to the open and continues trending lower to take out what? All the sell side liquidity that it built up going into the year. All the sell side here, sell side here, sell side here, here, here. Does March come back to take out some of that? Does April continue to trend down lower? Is February, what day is this? 13th? Who's higher? Here. Is February the 14th the high of the year? It's possible. Is the yearly candle making the high of the year right here? And price is going to continue to go short for the rest of the year. Because we know all yearly candles have the same idea, open, high, low, and close. There's going to be a false move for the yearly candle. And that's the whole idea. So is February the high of the year? Possibly. Possibly. We don't know for sure yet, but it's possible that it can be. But so far, we can see that dollar has shifted back bearish. And we're waiting to see if this is just going to be a false break. Or is it going to trend back bullish? Comparing this now to the bond yields. So now we're using intermarket analysis. We're going into the bond yields. Someone asked the question, can somebody explain the bond yields to me? And I said, sure, simply. The bond yields are a direct correlation to fiat currency, paper money, paper notes that we all walk around with in our countries. The yields are what drives investors to the actual currency, and the value of it either increases or decreases based on the interest rate and the yields. So when the central bank of the country increases its interest rates, the bond yields go up, which in turn gives strength to the currency because investors flood into that currency. Vice versa. When the central bank starts to cut rates, that means the bond yields start to decline and the currency starts to be less enticing or less as an investment, and investors leave the currency and try to find other investments that are better, that will give them a better ROI, rate of return, or rate of investment. So far, dollar has been king because what has the Feds been doing? They were on top of raising their rates quicker than other central banks. I'm not sure if they were the first central bank to start doing it, but I know they were definitely one amongst probably the first three central banks, at least the top third or top five central banks to start raising their rates rapidly to try and combat inflation, which is an excuse as well, but conversation for another day. You can see after they started raising rates, what happened? Dollar started to get strong immediately. Immediately, dollar got strong. Immediately. And other currency pairs or other central banks that didn't raise rates, they had a tough time getting their currency to be competitive. Prime example, Japanese yen. Worst currency on the planet right now, unfortunately. Well, probably one of the worst currencies in the world right now, just because they want to stick to a negative policy. So you'll see that the DXY and the bond yields are correlated together. When the bond yields go up, DXY goes up. When the bond yields go down, DXY goes down. So I just want to put it onto the chart to show you guys. DXY, new price scale, literally the same. Not perfect, of course, but literally the same. Just doing exactly what the bond yields are doing. We'll take this down to the 5-year. Same thing. These are old markups I had here, calling dollar to go higher in 2023. But yeah, same thing. Let's go down to the 10-year. Very similar as well. Let's go down to the 30-year. Similar as well. Nothing changes. And the same premise that I'm showing you here is happening here on the bond yields. So let's get rid of the DXY. The trend formula that we talk about. How do we find trend in the most easiest way possible? Swing lows and swing highs. It gives it up every time. Swing low broken right here. Let's bring it back right here. Swing low broken. What do we need to wait for after a swing low is broken? A lower swing high. Because this could be two things, a false break or a momentum shift, a bearish momentum shift. So the market could be shifting bearish, breaking this swing low. So let's play it forward. We had a fair value gap. Odds are it makes a swing high or a lower swing high in that fair value gap or on these order blocks here. Down close, not down close, up close candle, and then a runaway order block theory. Swing high forms inside that fair value gap right here. That's the lower swing high. I'm not playing it all the way through. There we go. Lower swing high. It's confirmed too. It's a confirmed lower swing high going into March. Huge drop for the bond yields. Lower swing high. So there's a sign that, weakness is coming into the market. And what do we do again? The pattern repeats again. Swing low broken. What should we expect to happen in the near future? Maybe price sells off a little bit, lower swing high. And that trend continues to unform. It's not going to be pretty. It's not going to always be very perfect, but at least we have an idea of how it should play out. Same thing is happening for the 10-year. What happened on the 10-year? Swing low broken. It starts up here. Swing low broken here. There goes that swing high or the higher swing high. After breaking that swing low, do we get a lower swing high? Yes. You can see price fails to break that high here. Price fails, gets up close to it, fails to break that high. Creates another lower swing high. It's an equal high, but it's a lower swing high. Then it also breaks what? Another swing low. So it's creating and destroying liquidity pools. It's not on the way down. It's going to be creating new buy-side liquidity pools because in the near future, it's going to come back and take out these highs. Whether that's 6 months from now, 2 years from now, etc. It's going to create liquidity pools to get back to it sooner or later down the line. I'm not trying to predict when it's going to happen, but in the idea, if it's going to go lower, it's creating new buy-side liquidity pools on the way down. And then you'll see at times where it raids some of the buy-side liquidity pools that it also created just to get sponsorship to continue going lower. Another, just showing justification of why I think EU, AU, GU, NU, all the majors are going to go higher. Even gold too. I showed that gold was going to shift. I showed that gold was shifting back bullish too. There you go. Break of a swing low here. Even here. The most recent one was here too. Here. Do we get a lower swing high? Yes, right here. And it's a break. It's also there. Higher swing high here. So something's going on. The 2 years showing the same thing as well. Swing low, higher swing high, lower swing high. That's trading 101. The structure there. We're doing this from the daily time frame. So it has precedence in the trend. I'm not doing this on the 30-minute. I'm not doing this on the 5-minute time frame. I'm doing this on the daily chart, guys. That's the whole point. You can do the same thing on the weekly. You can do the same thing on the monthly too. Let's take a look at gold. Gold, large range cycle, finally took off today. Huge run today. for stocks as well. Some stocks taking off. Nvidia is hulking right now. For those that are watching the stock market, Nvidia, ooh, if you invested into Nvidia, oh my gosh, bro, you made a bag in 2023 and going into 2024. But here, right here, swing high broken. I sent the same picture in the chart. I sent it when it was just like this. Swing high broken right here. And I was like, wow, gold took the time to come all the way back up here. That's very interesting. And I'm going to ask the question. Now, Jeremiah may know the answer to this. What candle is this? What kind of candle is this? This large candle down. Pablo, good job. Good answer. It's a smash candle. It's a smash candle, fam. Price is getting everybody to go short. This looks when this candle is here, it looks exactly. It's a smash candle. This looks like the sky is falling. It looks like the sky is falling. But it could be a turning point. It's probabilities, guys. It's scenarios. Price gets right there. That's where you want to go long. And you would hold, right? And then finally, gone. Completely smashed out all the sellers. And this was really strong too. This was a strong move. This was a very strong move. Price breaks a swing high. Look at that. Higher swing low. That's market structure going higher. Look at those higher swing lows. Now, I'm not saying that gold can't easily give a large candle right back down because it can. We see that all the time. Price gives a large candle up, large candle down, large candle up, or a large candle down, and then a large candle right back up. We see that quick rebalancing. Gold is very volatile like that. If price is going to continue to move higher, it's going to aim for what? Buy side liquidity. That's all it's doing now. It rated so much buy side liquidity too. Here, 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 and anywhere else. Wow, here too. This broke levels today, guys. Levels. I thought it was going to get here today. It did. Or just tapped it. Oh, it's just underneath it. Just underneath it. Right there. All that buy side taken out. Now, in theory, too, this can be a smash candle. Right? This could be a smash candle. We also have the highest high, the record high for gold versus US dollar right here. So price gold may just continue to make all-time highs and start trending. And this will probably lead me into the conversation of gold and why I think gold is just a very good asset to hold in general. Because at the end game, now we're gonna kind of move away from trading a bit and talk about like financial economics and global economics and just like, livelihood and situationship. Gold in general. Just want to take a look. This is probably going to be the last talk we have here. And I talked about this, I talked about this last year in a couple Forex Fridays too, and it's still showing proof today. Let's look at the max chart. This is gold's max chart here versus the US dollar. Let's look at gold. Yes, Jeremiah. Yeah. Someone said in the chat, wait for a down day, then buy. Yes. You can use that idea too. Look at this. This is the max chart. Gold versus Australian dollar. Beating paper dollars. Beating those currency notes that we all think is money. You can see I have here on the tab, I call this real money because all it does is go up. All it does is keep gaining value over time. This is at 3K an ounce versus Aussie. Let's go over here. Euro. Oh my gosh. Euro only had, at least from what TradingView allows you to track, Euro only had one gold versus euro dollar, only had two. This is the largest retracement or the largest crash, right? Technically crash for it. And after that one large crash, huge recovery, guys. Notice as well, same ideology that you just talked about, Jeremiah. Down candle, down yearly candle. If gold is down for if gold ever closes down in a year, buy the next year. Disclaimer, 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 disclaimer. I am not a professional advisor. I am not a CPA. I am not some type of guru, nothing. This is just me using my own education on what I see here. So if you put money into this market, that is on you. I have warned you. Can't say I didn't. Disclaimer, disclaimer, disclaimer. Everything that you see here comes with a risk. It's solely on you when you invest into things. Make sure you confide in whoever manages your money or manages your accounts. But just looking at the charts overall, we can see statistically speaking, gold makes huge recoveries after down years, especially down years. Let's take a look at gold versus CAD. See how that looks. Wow. Gold versus CAD, 2013 again. I'm not sure what happened in 2013. I know I was still in probably what, middle school or high school here. Um, yeah, still in middle school. No, yeah, I was just going into what, freshman year of high school. So I definitely wasn't in the headspace of trading. I wasn't a trader, I was playing sports and chasing girls and whatever the case may be, you know. But 2013, you can see, look, down year. If somebody would have invested after this down year, you know how much compounding they would have made? Even here, 2021, right? Right after COVID and stuff, down year. Price continues to run higher. This chart only goes up to the right? Just looking at it, it's going up and to the right of the screen. It's not like a trash stock or something. It's not going down and to the right of the screen. It's not like this and going to the right side. It's going up and to the right side of the screen. That's a healthy chart, at least for a investor's point of view. Let's look at gold versus pound. I'm not going to look at every single one, but same thing. Gold in the year of 2024 is still outpacing all fiat currencies to date. To date, guys, hasn't stopped. This trend has not stopped. This is a mega trend. Doesn't stop. Let's do one more just to really seal the deal. Gold versus New Zealand dollar. Wow. Last down year again here, 2013. Price continues going higher. 2024 could be only expected to continue going higher. Absolutely. Now, not saying that there won't be years where we get a year like this again. But if we do get a year like that, we know what to do. Now, most times we don't get consecutively down years of gold. Statistically speaking, we don't ever see that. So let's look at. I don't think we do. Let me just double check. Oh, we did for at least for gold versus U.S. dollar. We have, and the max amount of consecutive down years. And I'm not going to count these ones here because it looks like TradingView wasn't really. I don't know how it was being tracked here, but let's look at the ones where at least we were alive, and more in a mental space of being a trader. Most likely, it has an average of probably 2 to 3 years down, and after that, it recovers really strong. Most minimum is only one down year, and after that, it recovers strong. We don't ever see like 5 years down or 6 years down. We can see generally it's like, well, actually, we had this one period here. And I think this is something. I don't know what president. I think there's some president did this, I believe. I'm not sure what this was. I'll have to do my research again, but I believe something in history happened here that caused this decline. Or this one. I think it's either this one in the 80s or this one in the 90s. Something happened with one of the presidents and something happened and it wasn't good. Or economically, globally, something was not going on right. We had a decline. But after that, gold shot up. Straight up. So I tell you to say this. If you are looking for generational wealth, your best bet is to find an asset class that is one, not going to lose its intrinsic value. It is worth more than paper money because we keep printing it over and over and over again. We cannot print gold. It is impossible. That is God's gold, right? Not trying to be religious here, but it is God's money. It's God's resource. We cannot just print gold. Can't pull it off a tree. It takes time for these things to happen. Gold miners need to go and mine gold. Gold will always, exactly. I'm not gonna, yeah, F fiat currency, exactly. Gold ETF, exactly. See, you find ways. I'm only trying to give you a piece of advice because I know that the world isn't getting easier, right? This is all outside of trading right now. The world is not, and I don't like to sound all doomy and gloomy, but as I become a young man, right? I'm turning 26 this year. And I'm 25. My birthday's in October. October 12th is my birthday. As I become more educated and as I become more conscious and globally conscious and universally conscious, right? And conscious within, because I live in the United States and conscious of my economic system, I realize everything is just fraudulent. You start to see it's just one big game being played here on everybody. As much as we sit here and watch people get into, certain places of position or power and they're voted in and they're elected this and they run for this and they run for mayor and they run for this and candidential, etc., etc. They don't have the best interest for the general public almost every single time. Always understand you got your own back. You and only you and your family and your bloodline and your best friends or whoever you call your family or your amigos or amigas, etc. Whoever is in your family and who's close to you, make sure you have their backs because trust and believe this world doesn't. When it comes down to this money thing in this world, I've come to the realization that it's all fraudulent. It's sad to say. And it's just one big house of cards. And sooner or later, it's going to tumble. And who is it going to impact the most? Us. And I'm not saying it ain't going to impact me because it's definitely going to impact me in some nature, some form. Be prepared. If I had to make any investment that was sound, it would have to be gold. Outside of that, next would have to be a little bit of crypto. Not saying oh full crypto, not very versed on crypto. I know some people are really teched out and nerded out on crypto and they know a lot about it. A little bit on crypto. But paper dollars, bro, who gotta find ways to make that money make more money. And after that money makes you more money, go make more money. It's the reality. The grind doesn't stop. And I'm in my 20s just trying to work my way to success, trying to maintain success, trying to push the lid, and crack the lid of generational, poverty. Want to be the first in the family. If not, I want to be able to be multiple people in the family. I encourage other people in my family to do what I do, and etc. etc. And I have teach other people how to trade, teach them how to try to replace their 9 to 5, get a little bit of supplemental income by trading or learning how to invest in general. Be warned that prices of everything only goes up. When I was a little kid, I remember when a coffee cost a couple cents. A coffee does not cost a couple cents anymore. 10 years from now, when I'm 36, right, or 35 years old, cars are not going to cost the same price. Houses are not going to cost the same price. We got to do something about this. The time is now. Technically, the time was years ago. If I had, the information that I had now. But I'm glad that I know it now. And now that I know it, I'm not going to stop. I have to continue because I know what's going on. Please get everything in line. Whatever you got to do, pay off all your debts, if you got debt, pay it off. Get rid of that, slowly. As long as it takes you, pay it off slowly. Get your money into assets, stocks, cryptos, metals, ETFs, whatever it is, you know, the Vanguard, S&P, the Nasdaq, do something. Open a business, get a new trade. maybe work more hours. And I really wouldn't want people to work more hours, but look at the circumstances that we are in right now. A lot of countries have gone into recession. Look around the world. Look at it, right? A lot of countries have already gone into recession already. Japan, the UK, a couple other countries in the Eurozone already in a recession, technical recession, right? I think what, 3/4 in a negative GDP is a recession. The United States is up next. Come on. And supposedly the United States is supposed to be the world leader or whatever the case may be. Recession's coming. It's a cycle. The whole system is fraudulent. The recessions have to come because that's how it was designed. It was designed to fail, at least from my comprehension. Like I said, I'm not super versed in it, but from my comprehension, recessions are priced in to this whole thing we call life. It's priced in. Every couple years, there's going to be a recession. Every couple years, there's going to be some type of world disaster. It's almost like it's rigged because it is rigged. Ah, Argentina. Sorry to hear that, Pablo. Argentina is definitely going through it. I know. A lot of countries are going through it. Best believe. Even though not sitting here saying I got it all right and it's all sunshine and rainbows. It's not here in America either. Things are expensive from my point of view. Like if you guys ever want to talk about, hey, how is it in the United States? We could talk about that, and I will ask you guys questions too. Because the reason I really love the chat and I love what I do is because I've been introduced to a lot of people around the world and I have never met you guys. And it's really exciting. And I haven't really truly traveled the world myself per se. I've been to the Caribbean islands a couple times, and that's it. Barbados, Jamaica, Trinidad, back where my roots are, where my parents are from. But outside of that, I haven't really gone to other countries, the UK, Europe, you know, China, sure I haven't gone to those other places, Africa, I haven't gone. So it's nice that I'm able to connect to you guys here in 21st century through Zoom, or through a Telegram channel, and you guys live many miles away from me, and I can hear the inside scoop of what's going on in your country. So I like to stay globally conscious, but the only reason I tell you that is because gold has only outperformed, and I think gold is about to make its new leg higher. It is going to continue trending higher. Just look at the years. Just look at it. Year after year after year after year after year, it keeps going up. Keeps going up. I said early in the chat, find a position, buy and hold. It may not be the best buy. Of course, everybody would had love to buy gold down here. Of course, bro. But if you're an investor, the price doesn't necessarily matter. It's the long term. It may not be for you solely. It may be for the next generation or the following generation. Now I slowly started to understand. Okay, this is how families operate. This is how people maintain generational wealth. This is how certain people are able to stay ahead of inflation or able to adhere tough times because they've already placed it out, or somebody in the family took the leap. Somebody in the family took the conscious decision and said, you know what? I don't want to go out partying every single Friday, every single weekend. I don't want to be chasing after women. I don't want to have to be smoking my life away. I don't want to have to be drinking my life away. I don't want to do those things. I actually want to make sure that my future is secure. My potential, wife or girlfriend is secure, or whatever the case may be, my potential children, my future family, etc. The next generation is secure, and so on and so forth. And then you slowly start to see how empires are built and how people can better their lives or better their community as a whole. I always try to tell people it's not about the money. It's not about you. You think trading is about me? You think I do this because of me? It's not about me. It's about you guys. It's about my family. It's about my son, my daughter. I'm not saying I have a son or daughter, but when I do have the case, it's about them. I'm only 25 and I'm thinking about, okay, my potential family. So when I finally meet the woman of my dreams and I finally marry a woman, I finally start a family, I already got those things in line. I'm not trying to play catch up. I don't want to be 35. I don't want to be 45 years old and saying, oh, I should have, could have, would have. No, the time is now. So I'm gonna leave it off on a positive note. Invest. You got this. You guys are smart. You guys are intelligent. And even if you feel like you don't have time, you've got time. Try your best. Pass on information. You got grandkids, you got granddaughters, grandsons, uncles, I mean nieces, nephews, etc., cousins. Pass this information on. They may not understand it at first, you know, but if you work with them, you get it into their head. Yo, this life thing ain't no joke. You gotta invest. You gotta make money. Gotta get a job. Not saying you don't have to go to school. Go to school, get a degree, experience that. You know, if you want to be a doctor, be a doctor. Want to be a lawyer, be a lawyer. Want to be a teacher, be a teacher. Whatever it is that you love. But outside of your career, there needs to be an investment. I always tell people this all the time. It's even in my Instagram bio. This is the only thing I stand on right now. This is my motto for life. When I turned what I think 22 or 23, this was my motto. I said, you're either an investor or you're a consumer. And the investors tend to have a better life. And the consumers tend to have a short, lit, excited life for a short duration. And as they age and as they get older, they start to recollect and look back and be like, damn, bro, I let 40 years of my life go by and I ain't do nothing for my mom. I ain't do nothing for my dad. I ain't do nothing for my children. I didn't set no foundation for generational wealth. Don't let that be you. And even if you're older than me, even if you're a grown man, still time. There's still time. I just got my pops into investing, and he's well into his 50s. You know what I mean? Well into his 50s. He just started investing into Apple, Microsoft, um, Alphabet, Tesla, etc. He just got into it, and he loves it. You know why? Because he knows one day he ain't gonna be here. This is the real talk right here. He knows one day he ain't gonna be here. He knows one day I'm gonna bury him. He knows. And he knows one day all his proceeds and his investments, it's gonna go to me and my little brother. Right? He knows that. The same reason people do life insurance policy. Because if an accident were to occur or the day the person dies, all that money that they put in that life insurance policy goes to the family. Hopefully you found this insightful today. It's your boy Deontay signing out. Peace.